You click Buy. It feels personal. Your idea, your timing, your risk. But here's the uncomfortable truth most traders never sit with. Every time you enter a trade, someone just as confident is quietly stepping in to take the other side. And it's probably not who you think. Not another retail trader on their phone, not some random person guessing. Most of the time, it's a system, a firm, a machine designed to never care about the story you're telling yourself. That's what this video is about. Because once you understand who is actually on the other side of your trade, the market stops feeling mysterious and starts feeling unsettlingly precise. Stay with me. Right now, more people are trading than ever before. Zero commissions, instant execution, charts in your pocket. It feels like access has finally been democratized. But the structure underneath the market hasn't changed nearly as much as the apps would like you to believe. The question isn't, can you trade? The question is, who are you trading against? Let's rewind. A long time ago, markets were physical places, actual rooms, with people yelling prices. If you wanted to buy, someone else had to be willing to sell right then. You could see them, you could hear them. Today, you press a button and your order disappears into a black box. You never see where it goes. You never see who filled it. You just see filled. That convenience hides something important. Because markets don't magically match buyers and sellers instantly. Someone has to make that possible. Someone has to stand in the middle. Meet the market maker. That name sounds friendly, helpful, neutral. They make markets. They provide liquidity. They keep things moving. All true. But here's the part almost no one explains clearly. Market makers are not passive matchmakers. They are professional counterparties. Their job is to take the other side of your trade when no one else immediately will. You buy, they sell to you. You sell, they buy from you. Not because they believe what you believe, but because they are paid to manage risk, not predict direction. Think of it like this. You walk into a casino and place a bet. You're not betting against another gambler across the table. You're betting against the house. The house doesn't care if red or black hits next. They care that over thousands of spins, the math works. Market makers are the house. They make money on spreads, on speed, on order flow, not on hope. Let's make this painfully simple. When you see a price on your screen, that's not the market. That's a quote, a bid and an ask. Someone is offering to buy at one price and sell at a slightly worse one. That difference is the spread, and that spread is income. Tiny per trade, massive in aggregate. If you trade 100 shares and lose a few cents, it feels irrelevant. If you do that millions of times per day, it becomes a business. Now here's where it gets uncomfortable. Market makers don't just see prices. They see flow. They see waves of orders coming in, buy pressure, sell pressure, stops clustering, liquidity gaps. They don't know your name, but they know your behavior. And retail behavior is remarkably predictable. Most people buy breakouts. Most people sell breakdowns. Most people place stops at obvious levels. Not because they're stupid, because the charts teach them to. So when you enter a trade thinking this setup is obvious, you should pause and ask, obvious to who? Because if it's obvious to you, it's visible to the people pricing the market. Here's the quiet irony. Market makers don't need you to lose on every trade. They need you to trade, frequently, emotionally, at predictable points. Winning traders are tolerated. Overtrading is monetized. Now let's address a myth before it takes over your thoughts. This is not a conspiracy where someone is personally hunting your stop. It's worse than that. It's impersonal. Algorithms don't hate you. They don't chase you. They simply respond to incentives. If liquidity pools at certain prices, price will explore those areas, not to punish you, to transact. Stops are liquidity. Breakouts are liquidity. Panic sells are liquidity. You're not being attacked. you're being used. And that's not even the full picture. Because sometimes the other side of your trade isn't just a market maker. Sometimes it's a hedge fund unwinding a position. Sometimes it's an institution hedging exposure. Sometimes it's an options dealer forced to buy or sell because of gamma. Meaning, price moves not because of news, but because of mechanical obligations. The market doesn't always move because someone believes something. Sometimes it moves because someone has no choice. That's a hard pill to swallow when you've been told markets are about opinions and predictions. They're not. They're about flows and constraints. Now let's talk about the moment most traders recognize this but misunderstand it. They notice that price often moves against them right after entry. They call it manipulation. But think about the timing. You enter when the setup looks perfect, which usually means many others are entering too. Sudden demand, sudden supply imbalance. The market maker widens spreads, adjusts quotes, manages inventory. That adjustment often feels like rejection. Not because the market knows you're wrong, but because too many people tried to do the same thing at the same time. Crowded trades are fragile, and retail trades tend to crowd in the most visible places. Now, zoom out. This system exists for a reason. Without market makers, markets would freeze, prices would gap wildly, small orders would struggle to fill. They provide stability. But stability for the system doesn't mean fairness for every participant. Access is not equality. Speed matters, information matters, positioning matters. And most retail traders are operating with delayed data, emotional pressure, and fixed risk limits. They are playing a different game on the same board. So what's the hype versus reality? The hype says you versus the market, outsmart the crowd, beat the system. The reality is quieter. You are interacting with liquidity providers, risk managers, and automated systems that don't think in narratives. They don't care about your thesis. They don't respect your lines. They care about balance. That doesn't mean trading is hopeless. It means it's not what most people think it is. Understanding who is on the other side of your trade doesn't make you invincible, but it does remove the illusion. And illusions are expensive. Because once you realize you're often trading against entities that profit from volume, not direction, you start asking better questions. Why am I entering here? Who benefits if price chops? Where is liquidity actually sitting? You stop romanticizing trades, you stop personalizing losses, and you stop assuming the market exists to reward good ideas. It doesn't. It exists to clear risk. Here's the part no one likes to end on. The market isn't fair, but it is consistent. And consistency is something you can work with. If you know that someone is always taking the other side, if you know their incentives, then the real question becomes, are you trading to be right, or are you trading in a way that aligns with how the system actually functions? Because the other side of your trade isn't guessing. They're doing their job. The question is whether you understand what job you're really doing in the market, and whether you're okay with the answer.
Enjoyed this video? Like, subscribe, and hit the bell to level up your money game with Monetary Mentor.